You've done a fantastic job. Through years of hard work, you've accumulated a portfolio of multiple properties. So you want to take the next step and purchase your first commercial property. So in your town, you just found a cash flowing business park and then make an offer. Then you go to the bank and get approved for a loan. Congratulations, but not that fast. You have to make a down payment of 2 million. You make the numbers, and even if you sell your entire portfolio, you will be missing money. But the good news is that there are some legal structures out there that you can use to pull money from multiple investors so you can purchase this property. So if you're interested, stay tuned that I will explain them in this video. Okay, so how to raise money from multiple investors to purchase a commercial real estate property. But before, I'm gonna make a disclaimer. I'm not a financial advisor and I'm not a legal advisor. This is just for educational purposes. If you need legal or financial advisor, go with an expert. So that being said, let's start with this. First, what's the difference? There are two kinds of structures to raise money from investors to purchase real estate. The first one is a syndication. What is a syndication? A syndication is basically you are gonna raise money from multiple investors, but you have identified the properties. Even maybe it's one property or maybe it's multiple properties, but you already identified those properties. So you probably have it already under contract, and you go with your investors and you say, we are going to raise whatever amount of money, and then we are going to purchase this and this and this property. Okay, that's a syndication. Then there's another structure that is called a blind pool. Okay, so a blind pool, it's basically a fund. Okay, so you go to raise money, maybe you raise $100 million from investors. This is usually for big amounts of money. So you go raise $100 million and then you say, I'm going to identify later the properties, okay? Because it's a lot of money. I need time to identify the properties. So basically, the investors have to trust in you, okay? So because they have to trust that you are an expert and you are going to choose the better properties, the best properties. Okay, that's not the case in syndication, because in syndication you already have the deal, so you can show all the data to the investors and they decide if they want to purchase that property or properties or not. So that's basically the difference. Then what are the legal structures for this? Basically, you can use any kind of structure, okay? Any kind of structure where you associate with other people, you can use it. You can use a corporation for sure. But the thing with a corporation is that you will pay double tax, okay? You pay the tax for the corporation and then you pay the tax for the shareholders. So corporations are not really used in commercial real estate, at least in private equity. They are used maybe in something that it's called real estate investment trust, but we are not gonna touch this investment vehicle here. This is for private offerings. You mostly use limited partnerships or LLC. There are two kinds of LLCs. There are LLC, which is member LLC, which all the members of the LLC has the same rights. Okay, and there are some other types of LLCs that are manager managed. Okay, so that means you can have a manager in the LLC, but may or may not be the member on the LLC. Okay, it's basically the same thing as in the corporation, that you have these people managing the corporation and the shareholders are not managing directly the corporation. It's kind of the same thing. Okay, so these manager managed are the ones that we are going to use in the syndications or the blind pools. Okay, and then you have the limited partnerships. Okay, the limited partnership is very similar to a managed LLC, but the difference is, well, it has general partners. It has one type of partner that is the general partner, that is the one that manages the limited partnership, and then it has limited partners. Okay, but the thing with the limited partnerships for real estate is there were some changes back in the 80s. The IRS changed many rules for the limited partnership, and then you cannot, for example, if you are a general partner in this limited partnership, you cannot depreciate or take the losses. You cannot take the losses on the property. Okay, so for example, in a development, the first years usually you take losses. So if you make it in a limited partnership and you are a general partner, you will not be able to take the losses. Okay, only if you are a limited partner. Okay, so the two types of partners in these both structures, the limited partnership or the LLC managed, are the general partners. As I already explained, the general partner is the one, it's like the captain of the ship. Okay, so it's the one that manages the LLC or the limited partnership. Okay, it's the one that signs the mortgage, that signs the deed and all the contracts. Okay, and then you have the limited partners. Okay, that basically they fund the deal. Okay, they fund the deal, and and basically they don't have rights to vote. Okay, they basically are the investors. Okay, another difference in limited partnership than in LLC, it's all of the partners are limited liability. The general partner has not limited liability. Only the limited partners has limited liability. Okay, so usually if you are a general partner under the limited partnership, you have to create another structure like an LLC so you can block your liability. Okay, so that's another advantage of the LLC managed over the limited partnership. The general partner on both structures, as I explained, the general partner manages the ship. Okay, so because he manages the ship, he may put some money also, but it's not like the most important thing that the general partner does. The general partner manages the investment. Okay, so because he manages the investment, he earns some fees. Okay, so for example, for acquisition, when he purchases in a syndication, when he purchases a property, he can charge, not always, it depends deal to deal, but sometimes they charge acquisition fees. And then when he sells the property, he charges a disposition fees, or maybe if it's a ground up development, he charges a development fees. And almost in all cases, they charge management fees, because management fees, it's while they are managing the deal or operating the deal, they have to, they have to eat. So they have to take some money while the investment is cooking out, So management fees for this general partner, it's not the same as the property manager. You don't have to think it's the same thing. Okay, this is just for managing the investment. The other thing is managing the property. Maybe some cases it's not very usual that the general partner is also the property manager, but most of the times the general partner hires a property manager. Okay, but it's not the same thing. This is just for managing the investment, the money. Okay, and then also the other way the general partner earns money, makes money, it's with the promote. Okay, so what happens after you sell the property? Maybe you purchase the property for 5 million and you sell it for 7 million. So you have 2 million profit. Okay, so they promote, it's basically the split, the profit split. Okay, so you, before the investors put their money, you explain them in the offering memorandum and in the LLC agreement, you explain them how the profit will be split. Okay, so that's basically the promote. So the general partner has to make some money in this investment in order for him to be aligned with the goals of the investment. Okay, so if he don't make money when the property you have some profit, he will not be aligned, and maybe he will not care if he purchases something, a good investment or a bad investment. So that's why it's a good idea that the general partner makes money on the promote. The limited partners or the investors, they receive distributions from the rentals or the operations, and then on the sale of the property or the properties. So when you purchase the property, when you make the acquisition, you are having some rentals. So the limited partners, they receive money from those rentals, okay, according to the money they invested. Okay, so also, as I told you, if the general partner also invested some money, he can also receive money based on the money he invested. Okay, and also sometimes, not always, but sometimes the general partner can have a promote here, so, or a split on the rentals. Okay, but most of the general partners are only interested in the sale. When they sold the property, they are interested in the promote, because usually you don't have too much money here in the operations. You have this asking for money, it's not for everyone, because it's regulated by the Securities and Exchange Commission. There are two kinds of ways you can ask for money. One is the public offering, which is maybe you already know those public offerings on the New York Stock Exchange, on those regulated stock exchanges, but those are very expensive. So most of the companies or the small general partners, they don't go to the stock exchange, okay, unless they are a real estate investment trust or something that big, but it's another kind of a structure. But for this syndication, they usually go for the private offerings. Okay, so the private offerings, they have the Securities and Exchange Commission, they don't always regulate them. Well, they regulate them, but they have two exemptions. They have more exceptions, but the most common are two exceptions for the private offerings. It's the 506B and the 506C. Okay, so the difference is 506B, you can have up to 35 unaccredited investors. So what is unaccredited investors? It's basically your neighbor, it's basically everyone. Okay, so they don't ask you for any income or wealth or something. Okay, they just ask you that you have to give them an offering memorandum and some kind of things, and you have to fill a report with the SEC that you are going to be asking money to these people. Okay, the same way with 506C. Okay, same way, but this is for accredited investors. Okay, so accredited investors are basically wealthy individuals. Okay, wealthy individuals or institutions. So the SEC, the Securities and Exchange Commission, they have some rules for the accredited investors. For example, they have to earn more than, I think, 200,000 a year, or 200, I think it's 300,000 a year, and they have to have more than 1 million. I don't remember exactly the number, but they have to have some sort of wealth in order to be an accredited investor. Of course, they have to fill some kind of questionnaire, and then once they fill it, you can prove the Securities and Exchange Commission that they are accredited investors, and with this exemption you can ask for an unlimited number of accredited investors. Okay, so basically that's the difference. The B, you can ask up to 35 unaccredited investors, and the 506C, you can ask any, but as long they are accredited investors. Okay, so in the next whiteboard I'm going to show you an example of how raising money for a commercial property would look like. Okay, so let's take a look of how a syndication example could look like. So here we have a 5 million warehouse. We're going to purchase a warehouse for 5 million, and the acquisition price is 5 million. To make it simple, there's no leverage here. Okay, it's just cash. So we have a cap rate of 7%. Okay, so that means of net operating income, it's 7% of this amount every year. Okay, so the GP share will be 5%. We are, as I mentioned, the GP can invest or cannot invest, but most investors would look like to see the GP with some skin in the game. Okay, investing something at least 1-2%, but more recommendable it's 5%. Okay, so they are investing 5%, which is 250K, and the rest of the money is invested by the limited partners. Okay, so we have here a preferred return every year for the cash flows of 5%. That means we are gonna pay before the LP 5% on the total investment, and then we are gonna pay that 5% to the general partners, and then we are gonna split the profit from the rent or the sale on 70% to the limited partner and 30% to the general partner. Okay, on the sale we don't have a preferred return. On the sale we just split in this proportion. Okay, whatever the shares of the GP or LP it's, we are going to split 70-30. On the sale we can do something we can have preferred internal rate of return, though that it's more complex. To simplify, we are just going to split the profit on the sale 70-30. Okay, the whole term for this building is 5 years, and at the end of the investment we are gonna sell it for 7 million, so we have a profit of 2 millions. Okay, so we are gonna see the cash flows for the 5 years and the sale. Okay, so on the first year, since we have a 7% cap rate, we have 350 cash flow, net operating income. Okay, so same thing for all the years because we don't have growing the rent. Then we have the preferred return for the LP. Okay, so how we calculate this? This is the 5% of the total investment of the LP. Okay, so 4.75 million times 5%, it's this amount. Okay, so after we pay the LP their preferred return, we can pay now 5% on our investment to the GP. Okay, same thing, 250 by 5%, and then we pay 12,500. Okay, so now we have around 100K free because we have 350 cash flow less this number and less this number. We have 100,500, I think. 70% of that number goes to the LP because of the split. Remember, LP receives 70%, general partner 30%. So 70% goes to this, and the GP 30% receives 30% of that. Okay, so same thing all the years. We have not growing rate, and then at the sale we have a profit here. Okay, 2 million. The sale price 7 million, acquisition price 5 million. So we have a profit for 2 million. Okay, So that 2 million, we are just going to split it that way. No preferred return, no preferred IRR. So we split 70% to the LP, which comes to be 1.4 million, and 30% to the GP, to the general partner, which is $700,000. Okay, so we sum it up all the years, and we end up with this total amount that goes for the LP, including from the cash flows, from the rents, and also from the sale of the property. We total $2.93 million. Okay, and then for the general partner, we total $813,000. If we want to get the return over investment for each party, for the LP, it's 2.93 million, which is the profit, the money we get, and divided by the investment, by the total investment, and it comes to 70, almost 62%. 62%, okay, 61.7%. And then same thing for the GP, we have $813,850 divided by the initial investment, which is 250K. Okay, so we got 325% return over the investment over the total holding time, or the total holding period, which is 5 years. Why we have these numbers? Why GP it's making more return over investment? Because remember, he didn't invest that much. He made the money because of the promote, most of the money because of the promote. Okay, remember, he has to be aligned. Even if he isn't, you can see here, he is only making 30%, and the LP it's making 70%, but the LP it's investing most of the money. That's why you see this number growing up too much. That's the magic on the syndications and the blind pools. Okay, in this video I'll show you how to raise money to make a commercial real estate deal with syndications and blind pools. What other ways you know to make a deal without raising money? Leave your opinion on the comments. Thank you for watching the full video. If you like it, please give me a thumbs up. Really helps me a lot to continue spreading the word. And if you like to continue watching videos like this, hit the subscribe button. That way you will receive a notification every time I upload a new video. If you want to start investing in commercial real estate, but maybe you don't have the time or maybe the money to start in, you can join my exclusive investor club. My investors start investing from $20,000 US, and the best of it, it's totally stress-free. I manage everything. You can join by clicking on the link on the description below, and that way I will send you an email every time I find an investment opportunity for you. Thank you for reaching this point, and see you on the next one. But first, I will leave you with 2 more videos here.